Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you want to book a free call to discuss your personal situation.
Hello and welcome to another episode of the Brokers Lounge. As usual, you've got Eddie and Carlo. And for this one, we're doing something a little bit different where we've gathered a bit of questions that we've been asked over the last few weeks and over the years. And we've just compiled them and we're going to go through them and just, we'll give our answers to them as best as we can and just discuss some of the important ones that have come through and hopefully have some fun as well.
Looking forward to it. Should be good.
Yeah, but before we start, Carlo, how you doing?
I'm doing okay. Okay, I'm doing very good. Thank you for asking. But another big week, and looking at the calendar, and it's like we've only got a few weeks to go before Christmas, so it's the mad rush towards the end of the year.
Yeah,
It's good. It's a fun time of the year.
I know.
I look out the window now and the sun is shining a bit, which is nice. So it's always a good time of the year when the sun starts to come out and people feel a little bit more revitalised, don't they?
The Christmas vibe is around the corner.
Exactly right, yeah.
Sun is shining. It's just try and finish the year in one piece, I guess.
Yeah, that's always a challenge.
Plan for next year.
Yeah, exactly right.
That's it. Let's get going. How we're going to do this is basically Carlo and myself will ask each other the questions that come through and just go through them. So I'll start with the first one. Carlo, how does HECS impact borrowing capacity? Is it better to clear a HECS before going for a home loan?
Great question. And one we do come across a fair bit because people's HECS debts seem to hang around for a lot longer than they would have wished, that's for sure. So, and obviously with indexation going up, the HECS debts seem to be going up at the same rate as well. So look, there's no real easy answer to it, mainly because every person's situation is completely different. But what I did was just work through some quick examples and running the numbers just to provide our listeners with a bit of an insight as to what the effect does have by having a HECS debt or actually repaying that, what it does to their borrowing capacity. So the first one, and then this is pretty much just based off a single person that has no dependents, no other debts. So I'm going to make it pretty broad numbers, but for argument's sake, someone who's earning on $100,000 a year with no HECS debt, they can pretty much borrow about $550,000 just straight off the back, nice and easy. Throw in a $30,000 HECS debt, that borrowing capacity drops down to $490,000. So straight away, we've got a $60,000 difference there. Now, assuming they've got enough cash to purchase an actual property and be able to pay out the HECS debt as well, you do the numbers and you go, well, if I can repay $30,000 but gain an extra $60,000 in borrowing capacity, you're $30,000 better off straight off the bat. So in that case there, definitely makes sense to actually do that. You look at, let's say, a higher income of, say, $200,000 a year, and let's say it's a young doctor just come out of university, earning good coin, but has a much higher HECS debt of, say, $60,000. If they didn't have that HECS debt, they could borrow about $1,035,000. All of a sudden, if you throw in the HECS debt, it drops down to about $835,000. So straight off the back, that's $200,000 difference. But once again, if you can pay off that $60,000 HECS debt, you're still gaining an extra $140,000 in borrowing capacity. Right. Now, if I peg it back a little bit and go, right, what about someone who's earning a little bit less money? And I'll explain the reason why I did this one here as well, because I know they're all very similar, but someone who's earning, say, $70,000 a year with no HECS debt can borrow about $370,000. With a $20,000 HECS debt, for argument's sake, it's $355,000. So the difference is only $15,000. So in that case there, they're not actually gaining anything by actually paying off their HECS debt. And the reason for that is that, and what a lot of people don't realise is that the actual percentage of your income that's used to repay the HECS debt is based off your salary. So there's a sliding scale. It's not just a flat, say 4% or whatever it might be. I think the buffer, I took a screenshot of it because it's not easy to remember off the top of my head, but the threshold doesn't start until $54,435. So if you're anything below that, you're not even paying anything back.
Good luck borrowing anything.
Exactly right. But when you start off at that level there, the repayment rate's only 1% of your income, and that goes all the way through, which I didn't even realize it went that high, up to 10% of your income. That's if you're earning over $160,000 a year. So
there you go.
You do those numbers, and you go, well, that's why people aren't quite sure exactly what amount they're meant to be paying off their HECS debt, and because it works off that sliding scale. So hopefully that provides a bit of an insight as to whether it's worthwhile paying off the HECS debt or not paying it off. So once again, it is very individualised, that's for sure.
And I guess probably one more last point to note here, regardless how much your HECS debt is, it just gets calculated as if it's a full amount. So let's say you're only owing $10,000 on your HECS, that's where maybe it's worth paying it off, because it will affect your borrowing by X amount. So that's why it's very personalised based on your circumstances.
Right. Yep. Exactly.
Thanks,
right.
Carlo.
No,
very well.
Excellent. The next question we got, this one's for you, Eddie. Okay. How to get lending as a business owner with low reportable income? Yeah,
this one's a bit interesting. And I guess the right question here is with non-reportable income, not low reportable income. So that's where we tap into the low doc territory. And that's basically used when tax returns are not finalised as a self-employed client and you want to get some borrowing over the line. That's where we go down the low doc path. Now, what a low doc is basically, and this has changed a lot over the years. So it used to be a lot more lenient, just swear that you're making that much income.
Yeah, sorry, I earn X amount of money. Exactly. Thank you, that'll do.
Now it's more about self-declaration. So you self-declare your income, but this needs to be verified by your accountant. And that's where it's very risky on the accountant if they're not doing the right thing and signing a letter. It has to be based on something. Yeah. So the numbers need to be there. The business needs to be performing well, and they know that you're going to be okay with making those repayments. That's where accountants are more they feel at ease signing that letter. Yeah. But if you're not making the income, or the income is really low, then it's really risky, and not many accountants are happy to sign that letter these days. So that's the answer there.
Definitely noticed a bit of a shift from accountants. Their willingness to actually sign those type of letters. In the past, it was a lot easier to get them.
That goes back to tax office actually pushing a lot accountants not to sign these letters. Yeah, and they're putting more risk on the accountants if they're declaring the wrong thing. So
and as an accountant, why would you take the risk of signing something that's not really 100% correct? So
exactly. So hopefully that answers the question.
No, very good.
Next one, it's a two-part question, is it? So, okay, that's an interesting one. What are your thoughts on Macquarie Bank reversing their fixed rate cut after only 2 weeks? And do you think that directly correlated with the unemployment rate staying lower than expected, hence more money in the economy, or are there other indicators, factors that are in play? So probably worth giving some context here as well.
Yeah, so Macquarie Bank came out, and I know we talked about this in a recent podcast, with a lovely fixed rate of, they go down to 5.39%.
Yeah, it was 5.39%.
And then, unfortunately, just a few days ago, we received an email which was nicely written by Macquarie Bank. It was actually hidden anyway. That they'd raised their rates by 0.3% in terms of their fixed rates right across the board. So they went from being a market leader to not quite a market leader anymore. But my thoughts on it, fixed rates is always a difficult one to talk about, because there are so many different factors in play. Banks don't just say, we're increasing it because of X, Y, and Z. It's just like they have a multitude of different things in play. One could argue that, is it correlated to the fact that they also increased their savings account rates recently as well at the same time? So are they looking to boost their savings accounts on that part of their balance sheet by increasing rates? Who knows? Because they can't really increase on the savings account side and not on the lending side. It has to go hand in hand, really. So The other thing could be that there has been a recent recovery in bond yields. Now, typically banks will go out there and purchase their fixed rate loan funding through the global bond market. So typically when global bond yields are low, rates are low as well at the same time.
Because there's a margin for profit.
Exactly right. So now that we've seen that recover a little bit, I think it happened in late July, early August. Potentially that's another reason.
Yep.
Now, I'm not saying that is the reason, but it could be another reason.
We don't know what the reason is, for the record.
yeah, exactly right. And at the end of the day, banks also purchase parcels of funds that they utilise to offer in terms of the fixed rates. Maybe they exhausted all those funds and they're going, well, we've got enough, we've built up a bit more market share, or maybe it hasn't actually worked out, that they're not actually getting many fixed rate loans. So there's a lot of unknowns in there, but that hopefully provides a bit of clarity around the possibilities that sit behind it. In terms of my thoughts,
I've got a few things to add, if you don't mind.
Sure. Go for it.
So also I think which can be a reason is what we've seen when they drop those fixed rates, their turnaround times have blown out. So they over-exhausted their teams.
Yeah.
And this has blown out the turnaround times in terms of assessing applications and keep the the line moving, because Macquarie is known for their proper turnaround times.
Yeah.
And this has put them a bit off. So probably they thought, okay, we've got a bit too much to handle here.
Yeah.
So let's push them back, and with par with every other lender. So that could be another reason.
It's that juggling act, isn't it, really, in terms of do we
getting it right?
Do we gain market share at the expense of service level, or do we try and get that nice balancing between the two of them? So I'm guessing, knowing Macquarie Bank, they've always hung their hat on that great turnaround time. Yeah. So they probably don't want to be losing that feather in the cap. So very good. All right, next question. This is going to be self-managed super fund related, Eddie. So SMSF residential property purchase with debt. What are some of the restrictions, for example, minimum square metre, etc.? What's the maximum LVRs? And what's your typical interest rate as well?
Okay, so we've done a full self-managed super fund episode a few weeks back. So I recommend checking that out for more details. But for this question in particular, I guess some of the restrictions, obviously, in terms of square meters, like this comes down to lenders' policy, and usually lenders do not accept anything under 50 square meters, and that's usually an apartment. So that's where you have to be mindful and just run the property with your broker before signing the contract to make sure this is an acceptable property. Obviously, if you're doing something like multiple hectares or something with power lines,
location to a regional centre.
Yeah, so there's a few things that you just need to be mindful about. And when you're doing a self-managed super fund property, just aim to get your normal everyday property without being too fancy about it, because there is some restrictions. In terms of LVR, maximum LVRs are 80%, so you can't go over 80%. Also be mindful that the lower the LVR is, the better the interest rates can be. So typically on an 80% LVR, your average interest rate is around 7.5%, and this goes down gradually as your LVR goes down. So the lowest, I reckon, is about 7%, around the 50 to 60% LVR. So
it has to be around that 50% mark. So.
Yeah, so that's it. Anything else I missed?
No. Like you said, we have done this podcast on this particular topic. So, and in a lot more depth. So it's probably good referral point back to that. So
that's it. Your one, Carlo. Also a 2-part question.
You love the 2-part questions.
Well, I'm just passing the message on the messenger. All right. So, how has servicing changed over the years and the buffer that the banks now look at when assessing loans? And 2, do you think that buffer will reduce at some point?
Hot topic at the moment. Firstly, I guess, how has servicing changed over the years? If I go back to when APRA first introduced the servicing buffer, that was back in 2014. I didn't realise it's already been 10 years since they've been doing this. That initial buffer was only 2%.
Yeah.
Then as rates started to go further and further down, we headed into COVID, They changed it in 2019. They increased it up to 2.5%. And then at the back end of 2021, as we came out of COVID and rates, the cash rate was 0.1%, they increased the buffer up to where it is at the moment, which is at the 3% mark. So what has that done to people's borrowing capacity in terms of where rates have been, say, coming out of COVID to where we are today? And I just utilise some quick numbers around, someone who's earning $100,000, when rates were, say, around 3.2% or thereabouts, your borrowing capacity was about $550,000. Sorry, I'll mix it up, put it the wrong way around. The borrowing capacity was about $735,000.
You gave the answer.
Exactly right. So now you know what it is at the moment. It's $550,000. So that difference in that, and we're not talking about the buffer, which is just talking about.
The 550 is on what buffer?
That's on. So it's still in the same buffer.
Yeah.
But what we're talking about is what rates were like 3 years ago.
Okay.
As we came out of COVID to where they are today. So nothing to do with the actual buffer, because the buffer's been in place for the past 3 years anyway. But just that change in interest rates over the time, what that's done to servicing capacity, it's dropped it by about $175,000.
That's from 2% up to 6%.
Correct.
Roughly.
Yep, exactly right. The second part, do I think the banks will reduce the buffer at some point? Possibly. I don't think anytime soon, mainly because I think yesterday there was an article in the Financial Review which talked about the Australian Bankers Association, lobbying to get that buffer reduced for first home buyers. So I think if we see at any point that buffer reduced, it'll be probably to start off with in that first home, targeted towards those first home buyers, because they're the ones who typically need the help as much as possible. So, look, I'm not too sure if they're going to go down that pathway. I think out of all the banks, I think NAB was the only one who agreed with the Australian Bankers Association. Westpac and CBA weren't in favour of that. They were actually comfortable with the current 3% buffer. So, because I think they just believe that reducing it will increase the potential for more defaults in the market. I think that until we see how interest rates play out over the next 12, 24 months, I think the APRA will probably still sit on the 3% for the time being. So
I've got a follow-up question on that one. We've seen some policies with certain lenders regards the buffer rate. So it's not like a national policy, but certain lenders apply lower.
I think we've got
rates.
From memory, it's probably about 8 different lenders on our panel who offer what they call a reduced buffer serviceability.
Yep.
So, and this is purely aimed at those who are wanting to refinance. So as we saw a lot of clients come off their fixed rates and and then going to variable rates. A lot of them were going from 2% rates to 6.5% rates.
Yeah.
So the banks, a lot of people were priced out of the market because it's like, well, I'd love to be able to refinance and get a lower rate, but I can't because the serviceability is completely out of whack now compared to what it was when they took out that loan. So
that's what we call the mortgage prison. Like people get stuck with
exactly
that.
Right. Yeah. And so the banks came out. Some of them came out and said, well, if you're going to just do a refinance, pretty much a dollar for dollar type refinance, we'll reduce that 3% buffer down to 1%, which obviously took a lot of people from not being able to show serviceability of their loans to actually being able to do it, allowing them to take the handcuffs off their current bank and head into another bank with a much lower rate. So,
perfect.
Okay, my turn to ask Eddie another fabulous question. This one is it best to take the hit and pay LMI, Lender's Mortgage Insurance, or wait to have the full 20% deposit?
Yeah, this is a very good question. And usually we do a lot of work with the client when we're working around this question. So I hate to say this, but it's up to your personal circumstances, because I get a lot of people saying, every time we ask a question, you say it's up to your personal circumstances. But this is the reality of it. So there's a few things to consider, I guess, which can outline which way to go. If you're looking at doing the 20% deposit, that really comes down to the level of savings you've got. And if you've got that 20% sitting there and you're willing to use it and cover the 20% deposit and stamp duties, then by all means, go for it. When it comes down to buying an investment property, I guess more, that's where the question of cash flow versus deposit and LMI
Mhm.
is put on the table. So if you're buying an investment property, most of the times you're looking at maximizing that debt, using that cash savings you've got towards your owner-occupied debts or non-tax deductible debts. So a lot of people choose to maximize that debt and take on lender's mortgage insurance, because that can be helpful to get you into the market with a lower deposit and just go up to 88 or 90% deposit. So just use 10% and cover the cost involved and maximize that debt. So it comes down really to working out what's more suitable for your circumstances. What's your plan after this purchase? So it's not about just this purchase. Are you planning on buying another property in the next 6 months? Can you use that 20%, split it into two and buy two properties? So there's a few questions that we need to go through to work out, is it best to do 20% or do 10% and take on lender's mortgage insurance? Be mindful that lender's mortgage insurance is not huge considering the investment you're doing. So a lot of people choose, I'll take that 15K in lender's mortgage insurance, add it to the mortgage so you're not paying it out of pocket, and save myself 60K, let's say, and another 10% deposit and use that somewhere else. So it can be a very good strategy to use the minimum as a deposit to buy a property. And also, if you're an owner-occupied, buying your first property or an owner-occupied property, and you don't have the 20% deposit, it might be very important getting into the market instead of waiting until you have the full 20% and missing out, and then property prices go up and you're just chasing pretty much the ability to buy that property. So it's really down to personal circumstances, but these are just thoughts to think about.
Yeah, obviously the moral of the story, come to us with your individual circumstance and we'll help you run the numbers and help you work through the right answer. So.
That's the theme of the podcast today.
Exactly right.
All right.
Fire away.
Ready?
Yes.
Have banks gone too far in respect of the granularity of assessing household expenses? I guess Shakespeare asked this question.
Yeah, I like that. Granularity. Yes and no. Look,
Sherlock Holmes.
I think some banks have definitely gone a bit too far in terms of, I've had assessors who have come to me and said, we're going through the bank statements line by line and adding them up, and the clients have declared X amount under groceries and we've calculated it at this amount. Can you please explain it? And that's where it's probably going just that little bit too far, because, when I know if someone said to me, can you articulate your household expenses? I'll be like going, no, so I can't, because it's too.
You're hiding a pet.
Exactly right. All you can do is just estimate at the end of the day. So, look, and I understand why sometimes the banks have done this, because in the past we've had a lot of people who have understated their expenses, and understating your expenses can lead to further issues down the track and potentially defaulting on your loan, because you think you're only spending this amount, but you're actually spending that amount, and then all of a sudden you get a new loan, and what something's got to give. So it's important that, I guess, the moral of this part is make sure you take a bit of time to just go through your expenses when you're asked to do so by your broker or the bank, and make sure you try and give them the best possible answer so that they're not going through. You don't want to give the bank any reason to go through your bank statements line by line and working through your expenses. So
highlight any one-off.
Yeah, correct. Because there are minimum levels that the banks will work off, what we call HEM or household expenditure measures. So make sure that it's it's fairly much in line with that. But we'll guide you obviously with regards to that if we see that it's just way too low. So
can I add something here?
No.
Okay,
so go for it.
Let's go on.
Okay, right.
I think they're a lot better than what I've seen in the past, because
definitely.
There's this story that it was just outstanding. Back when during the Royal Commission period, I had a client come for refinancing, and I ordered a valuation. I can't remember the bank. I think it was one of the big four, but I can't remember which lender it was. So we've ordered a valuation. The valuer went, valued the property, took photos, whatever, and then sent the report back to the bank. This client was a single client, no kids, straightforward. The assessor calls me when they got the report, and they said, you declared that the client is single with no dependents. I was like, yeah, they're single with no dependents. He was like, then how can you explain the kids' photos on the fridge on the back of the evaluation report? And it was like, whoa, this is next level. And I was like,
nieces, nephews.
Yeah, exactly, man. And I was like baffled by, the level, like just looking at the photos and so it's definitely not at this level now, which is a lot better, but I thought it's worth sharing.
Yeah, very good. All right, we're going to keep moving. Eddie, what is a guarantor arrangement and how can I use this to buy a property?
All right, so with guarantors, there's typically two arrangements for guarantors. There's the servicing guarantor and there's the security guarantor. Servicing guarantor is very technical and probably 99% of people do not qualify to be servicing guarantors because you have to be what banks call a sophisticated investor, and you have to have a minimum net worth of 2.5 million plus, and you have to have certain level of income. So a lot of people don't qualify for that. The other very important guarantor thing that most people qualify for is the security guarantee. And that's basically when you use a family property as a security to cover the deposit that you need, plus stamp duties and fees to cover your purchase. So if you're buying a property for, assuming $600,000, and you don't have the deposit to cover you don't have the funds to cover the deposit and fees, so you use your parents' property, which can allow you to cover the 20% deposit plus stamp duties. So that would cover the 150, 160,000 needed, assuming you can service the full debt and assuming there's enough equity in the parents' property to cover the debt. The parents do not need to show income or servicing abilities. You need to be able to cover the full amount. And once the LVR is reduced to 80%, that guarantee can be withdrawn. So, yeah.
Good option.
It is a very good option.
Yep.
And
if you do it right, it can be definitely to everyone's benefit. So
there's a bit of risk involved with the parent putting their property as a security, but that comes down to the relationship and the character of people involved. So, all right, next one. I've been with my bank for 15 years. Why won't my bank offer me the same deals on rates as they do to a new customer? If you have to answer this question in 3 words, what would it be?
Because they don't want to. I don't know. I can't answer in 3 words.
They don't give a shit.
Loyalty. It's loyalty tax.
Yeah.
Essentially, that's what they call it. And look, why don't the banks offer it? It's pretty simple. It's more beneficial for the banks to offer better rates for new customers because that's business they didn't have previously. They understand that as an existing customer of the bank, it's harder for you to actually just up and leave and go to somewhere else. Although we can make that a lot easier for people, but so they will typically charge that little bit less to get brand new business in the door. It's really as simple as that. There's no magic to this. What I would say is, and we've done this quite a lot with people, if someone's we've organised a loan for someone, and then a few years down the track we see that their rate is no longer competitive, we'll go back to their existing bank and get their loans repriced. So it's not to say that once you got a loan with a bank, that's it. It can't be changed. It can be changed.
Yeah.
It's a matter of asking the question. And we do this as part of our ongoing review with our clients. And when we look at their facilities and we match it up to the market, we want to make sure they're still getting the best deal. And refinancing isn't always the best option for clients. So it's definitely worth asking the question because you just never know what the bank will come back with. But, going through a broker, we have the knowledge as to what the market is pricing a facility at. So it's important to have that background knowledge as well. So.
And I guess that's the importance of working with a good broker. It's doing those annual reviews and making sure your interest rate is always competitive. So
it's not in our eyes, it's not a set and forget.
You don't need to worry about it. Someone's doing that for you.
Yep. Yep, exactly.
Sweet.
All right, Eddie, can I still get a loan as an Aussie expat living overseas?
Yeah, absolutely. And
love this one.
Yeah, that's something we do a bit because we've got a few clients living overseas, especially in Singapore or United Arab Emirates or England. And as long as you're an Aussie, you can get borrowing to buy a property in Australia using your foreign income. Now, obviously, the criteria is slightly different. It's a bit more involved because the banks look at it where you have to exchange the income you're earning in the foreign currency to Australian dollars, and then they shade it down to 90 or 80% depending on the lender, and then they tax that income. So the income you're earning will be a lot less, but having said that, usually expats earn high incomes, and we've done a few where there's no issues at all, and you can still get competitive rates and just go about it normally, but it's a matter of ticking the criteria and making sure serviceability is there. But by all means, yes, you can as an expat living outside Australia to buy a property in Australia.
Yeah, and I think that's probably maybe a good topic for us to explore in a little bit more detail, maybe in another podcast down the track, and cater it to some of our listeners who may be overseas and an Aussie expat. So
good idea.
Like that one.
Highlight it. All right, next one. How soon can I pull out equity given there is some?
Tomorrow. There's no time frames. Typically it's going to take some time to actually build up some equity in a property, unless you've been able to purchase a property that's at a super low value or below market,
or do renos.
Exactly right. Yeah. So it's just a matter of getting to a point where there is available equity in there. So there's no minimum time frame. There's no maximum time frame. It's just a matter of assessing whether it's actually worth your while going in the pathway to pull out extra equity, if there is some available to you. So not a long answer, that's for sure, because there really is no minimum time. So
that's it.
It's just a matter of just reassessing at any point in time. So
and just getting a valuation done to see if there is any equity to use. So all right.
Only a couple to go actually. This is almost similar to the Aussie expat one, but I hear Americans speaking a lot of building a credit score and taking on a loan to build this. Is that relevant in Australia?
Well, not trying to be stereotypical here, but first of all, don't hear to what Americans say.
Sorry, that's Americans. A good answer.
The second answer is no, it's not the same in Australia. So I guess in America, having debt plays a huge role in building your credit report, especially credit card debt. And I don't want to be a conspiracy theorist here, but I guess that's the way to get you into debt and take on more debt and spend on your credit card, and just banks make more money. In Australia, that's not the case, which is great. So if you're starting out, if you're thinking you want to build up your credit report, you don't need to do any of that. Just try not to miss any repayments. If you've got any debt, just make sure you're not taking on unnecessary debt. You're not doing lots of inquiries with smaller debts, personal loans, all that sort of stuff. So just don't stress too much about it. If you're starting out, you don't need to have a huge history of your credit report. You don't need to have history of repayments. I've never seen someone starting fresh getting knocked back because they don't have history on their credit report.
I can give you a classic example. My daughter bought a house just over a year ago now, close to 18 months ago. Has never had a credit card in her life. Her fiance never had a credit card in his life. No personal loans, nothing. Got a home loan, no worries at all. Credit score was not an issue. Yeah. So classic example, and I've seen it with lots of people. So.
Don't take debt just to build up your credit report.
Yeah.
That's a myth.
Excellent, good answer. Now I've got one final question for Eddie. I'm not too sure if he's expecting this. And this one actually came from one of our directors, Josh Lee, because he remembered it from a recent podcast. But the question goes, does your co-host Eddie still think there will be a rate cut in December?
This question is haunting me now.
We should have put a bet on it, you know that.
Yeah, look, I said it before and I'll say it again. My mind says no, my heart says please, yes. I don't know, obviously, but like I said before, I'll just stick to it. Worst case, I'll lose the bet.
Man of his words. I love it.
The bet, but Yeah, look, it doesn't look like it, but you never know. Like, it's a very dynamic situation out there, and things are changing a lot.
Yeah.
Obviously, all the figures come in, whether it's inflation, whether it's unemployment, whether it's economy, it's all pushing towards a rate cut very soon. But when would the Reserve Bank take that decision? No one knows. So we'll wait and see. We're only, 6 weeks away. So the moment of truth is coming.
My bet is looking pretty good. That's all I can say. So
Carlo's one is in March. So if he gets it right in March, I'm shouting out lunch or dinner.
Wow.
There you go.
Oh, there we go.
Just to see.
You heard that.
I've put something on the bet.
I'm glad this is on video. Fantastic. So, look, I think some great Q&As in today's podcast.
Yeah.
Apologies to those who sent through questions and we haven't been able to get to them. Having said that, it probably allows us to do another Q&A session,
why not?
maybe possibly towards the end of the year as well, and hopefully we'll be able to cover those. Thanks again, Eddie, for today. It's been a good session. It's been good. It's a lot different than just talking about one particular topic. So once again, continue to send through questions, comments, observations. Subscribe to our podcast. Give us that lovely 5-star rating. We'd really appreciate it. But until next week, we'll call this a day. Thank you very much.
Thank you.
Take care.
Bye.